So good morning, everyone, and welcome. I'm Cathy Roussel. I'm the Head of Advocacy and Engagement at amfori, and I'm very pleased to open today's webinar on understanding CSRD ESRS, everything you need to know about EU sustainability reporting standards. So thanks again for joining us. We know that the last couple of months have been pretty intense when it comes to legislative developments, and I believe that your presence today shows how important it is to have clarity on these developments, especially for businesses who have to navigate these changes. The topic of CSRD and ESRS reforms have been one of the hot topics on the agenda of amfori Sustainability Working Group over the past year. And we wanted to make sure that we could meaningfully engage with policy makers and have a voice in these discussions with our member support. And our advocacy team has contributed to the omnibus consultations, to the EFRAG ones, working also with partners to ensure that simplification efforts remain practical, proportionate, and aligned with business realities. And this brings me to the connection with last week's webinar on the Omnibus deal, which was looking into the CSRD framework. Today, we focus on what these changes mean in practice for your sustainability reporting under the CSRD. So over the last year, given the policy uncertainty, we have received requests from many companies wondering if they should pause or stop their reporting efforts. The simple answer to that question is no. So even with proposed adjustment, companies should not delay. ESRS will continue requiring meaningful decision, useful disclosures on impacts, risks, and also opportunities in alignment with the CSRD strategic objectives. Our position, I would say, has always been clear. We wanted to make sure that any simplification effort would not come at the cost of the core principles, such as double materiality and value chain transparency, which are critical to meaningful sustainability reporting. The good news is that even if the ESRS are still to be reviewed and adopted by the Commission, the core principles will remain untouched. So it looks like EFRAG managed to reduce the number of data points without turning the corporate reporting exercise into a pure tick-the-box administrative effort. So I will not be spoiling the rest of the webinar because experts will explain this much better than I would, but in a nutshell, I would say that it looks like the proposed changes will still allow for reporting with impact. You can move to the next slide. So now, before we dive in, a few practical reminders and housekeeping rules. All participants for this webinar will be muted, but this doesn't mean you cannot ask questions. Actually, I would invite you to ask questions and use the Q&A box, not the chat, to include them so that we can track them properly and aim to answer to them towards the end of the webinar. Also, an interesting point of information, after the webinar, there will be a satisfaction survey. With amfori, we also believe that, continuous improvement is important. We take your feedback very seriously. So I would really kindly ask you to complete it as well when the webinar will be over. You can move to the next slide. This webinar that we're having today is part of our broader advocacy-led series. It is part of our efforts to support companies not only in representing your interest in Brussels, but also by providing guidance and timely guidance so that you can anticipate regulatory changes, you can plan effectively, you can stay aligned with EU expectation. And today's webinar on ESRS 2.0 is really a key moment to take stock and to understand the direction of travel. Next slide, please. So over the next hour, we will cover the political and legislative context of the ESRS simplification process, the proposed ESRS revisions, what is changing, what remains stable, and then explain what this means for your reporting and how amfori tools remain aligned with the new direction. And there will be, as I said earlier, some Q&A toward the end of the webinar. You can move to the next slide. We are very fortunate to be joined today by my colleague, Amanda Soler Guzman, Advocacy and Engagement Advisor at amfori, who has been monitoring this file from early stage very closely. And we are also extremely lucky to have with us Philip Gregor, Head of Responsible Company Section at Frank Bolt and member of Sustainability Reporting Board at EFRAG. So both of them will walk us through the plan changes and what these will mean for your reporting exercises. Next slide. So finally, a short disclaimer here, since the ESRS revisions are not yet final, so they remain subject to political approval, including a yes or no vote in Parliament and Council once a delegated act is proposed by the Commission. So we will continue keeping members informed as the situation evolves. So I'd like to thank you again for joining us this morning. We really hope that today's session gives you clarity and confidence as we are entering this new phase of sustainability reporting in the EU. And I now have the pleasure to hand over to Amanda, who will start walking us through the ESRS context. The floor is yours, Amanda.
Thank you very much, Kathy. I'm very pleased to be moderating this session today. And thank you for setting the basis of our discussion in this webinar, and the mention that we are indeed entering a new direction for sustainability reporting, which is exactly what we will discuss in the presentations. But before we dive into the details, I would like to provide a little bit of context. So where do the ESRS revision actually come from? Important to mention that the ESRS revision is actually part of the Omnibus 1 package, which was released in February 2025 to simplify EU rules for sustainability reporting and also due diligence. So the Omnibus package actually contains two, I won't get a lot into detail because of this, because my colleague Valentina, together with other colleagues from amfori, already ran a webinar last week where they unpacked what the main provisions of the Omnibus 1 are. But maybe as a recap, the Omnibus package looks into two different types of legislation. Level 1 corresponds to the framework legislation that set the rules for sustainability reporting and due diligence, namely the Corporate Sustainability Due Diligence Directive and the Corporate Sustainability Reporting Directive. Those are framework legislation, which means that they set the basis for those exercises to happen, which means the what and the who. So who is in the scope, what actors need to do. On the other hand, the Omnibus also includes or mentions the need for the Commission to come up with secondary legislation. And here is where you see the ESRS and also the upcoming voluntary standards for SMEs that will act as a value chain cap. I think we will go into this into more detail in a moment. And both types of legislation follow different procedures. So for level 1, it normally requires what we call an ordinary legislative procedure, which is where the Commission and the co-institutions, so the European Parliament and EU member states, engage in long discussions, and the final text that is agreed on usually incorporates substantial changes. For level 2 legislation, It is a little bit different. It involves a more straightforward process, which a yes no vote in the European Parliament and the Council. So the Commission comes up with a file, and then it grants a period for the co-institutions to object to it or not. And then if there's no objections, the text is approved. Just for the record, today we will be focusing on the second level of legislation and mostly on the ESRS. And I think we will move on. So how did we get here? Something interesting to mention is that in 2023 and 2024, we already had a CSRD and a CSRD in force. And as part of the CSRD requirement for companies to come up with a sustainability report in 2025 based on the data collected throughout the financial year of 2024, the Commission already adopted a first version of the ESRS in July 2023. And similarly, aware that there would be other companies that were not falling into the CSRD scope, but they are part of the reporting ecosystem because they fall in the supply chain of larger clients that were under the scope or that had to answer the requirements of investors. In order for those to compete in fair terms with companies that were had to do the reporting exercise under the CSRD, and also to streamline the data requests and to help those companies to kickstart their sustainability journey. The Commission also adopted a recommendation with the voluntary standards for SMEs. Important to mention that this was not binding because the next voluntary standards for SMEs, they will be binding. They have a binding nature. And then what happened from then is that after multiple internal and external discussions, exchanges with stakeholders, and a 3-month public consultation that collected more than 700 responses, EFRAG, the main technical body in charge of drafting the standards, submitted the draft standards. Let's call them ESRS 2.0 for clarity purposes in December 2025. And then what is next? So the co-legislators agreed on the final text, the final deal of the Omnibus 1 package in December 2025. And within the text, there is an obligation for the Commission to revise the ESRS 1.0 and come up with new ESRS within 6 months from the entry into force of the Omnibus Directive. And likewise, to come up with a new version of the voluntary standards for SMEs, which will come in the form of a binding delegated act, same as the ESRS 2.0, within 4 months of the entry into force of the Omnibus Directive. So, because we expect that the Omnibus Directive will be soon receive the final approval by the Council of the European Union, and then it will be published in the official journal of the EU and enter into force 20 days after that. Around April, then we expect that the ESRS and the voluntary standards for SMEs will be finally adopted around Q2, Q3 this year. And I think without further ado, we can pass the floor to Philippe from Bold, who will guide us through the main details. Philippe, the floor is yours.
Thank you, Amanda, and hello everyone. I was introduced, but just very briefly, I'm with Frank Bolt, but I also serve on the EFRAG Sustainability Reporting Board. So I've been involved quite heavily and intensively in the development of the draft ESRS 2.0. But in the first part of my presentation, I'll focus on the critical changes. And if you can go to the first slide, I can start explaining what's on my mind. Right. So before we get into the nitty-gritty of the new standards, I wanted to guide you or walk you through, let's say, really high-level changes that come not just from the CSRD and ESRSs, but also from their interaction with the CSRD, the Due Diligence Directive, and also from, let's say, market practice. So looking at it from the perspective of sustainability reporting, there are three major changes. One concerns climate transition plans. The other concerns, let's say, the emphasis or strengthening of the risk-based approach, very much in line with the due diligence kind of a concepts, both in the CSRD and ESRSs on the reporting side, as well as in the Corporate Sustainability Due Diligence Directive itself. And finally, there's the elephant of in the room, which is that if 80 to 90% of companies are now excluded from the scope of the CSRD and CSRD, what is it that they're supposed to do? And one thing that people don't really see about the omnibus is that it's not just that the thresholds for the personal scope are increased and the companies kind of fall out of the legislation, but also that most of the text in the omnibus directive, or if you may call it like that, is about the expectations on what these companies out of the scope of the CSRD and CSRD still need to do and provide in terms of sustainability information to their business partners. So I'll speak about it a little bit as well. But let's start quickly with the climate transition plans. That's an easy one. So please, let's go to the next slide. So first of all, I'll be saying things that you probably are already aware of. In the CSRD, in the Due Diligence Directive, the article with the obligation for the largest companies to develop climate transition plans has been deleted. So there's no behavior obligation anymore for climate transition plans in the legislation. In the CSRD, in the reporting directive, however, the disclosure requirements for disclosing such climate transition plan, should company have it, remains. And so it remains in the standards in the ESRS 2.0. But one thing that's a little bit hidden from the plain sight is that the legislation that applies to the financial actors, financial institutions, banks, insurers, and investors has not changed as regards their own specific climate risk and climate transition obligations. So the prudential regulations and the supervisory guidelines for banks and insurance companies remain in place. Remain in place, and they are very much focused on climate risks and climate transition. And in the SFDR, the Sustainable Finance Disclosure Regulation, which is the disclosure regulation for the investors, the aspect of climate transition is going to be strengthened. This regulation is also undergoing a review, not as a part of the omnibus, but in a separate process. And the changes will be quite radical. There will be new mandatory categories of sustainable finance products, and they are really revolving around the concept of climate transition. This has quite strong implications, but let me explain on the next slide. So here you can see some numbers from the research into the reports of the first wave companies. First waves are those companies that already had to report in accordance with ESRS 1.0 and the CSRD. And 50% of these companies have presented a transition plan, a climate transition plan, as part of their sustainability reporting, even though they were not under any behavioral obligation. I will not guide you through the rest of the slides, but just to give you an idea what you could find in our research publication and other outputs. But the important point here is that the climate transition plans are a de facto market practice. And as I've tried to explain on the previous slides, the demand for the information on climate transition and climate risks is not going to go away thanks to those financial regulations. And that is without, let's say, without any that's not basically dependent on whether a company is covered or not by the CSRD and CSRD. So much for the climate transition plans. The next one, please. Now, on the risk-based approach. So the changes that were introduced in the CSRD, the due diligence directive, as well as in the CSRD, but mostly in the ESRS, in the standards for reporting under the CSRD, largely revolve around the identification and assessment of adverse impacts. So you're now looking at the familiar OECD kind of a diagram which illustrates the steps in the due diligence. So this really corresponds to that step number 2, identification and assessment of adverse impacts, which is something that you need to do for materiality assessment in reporting, as well as kind of a first step in the due diligence process, ongoing due diligence process. So all of the changes that try to basically simplify some basic concepts in sustainability reporting and due diligence legislations are really centered on this particular step. So let me show you what these changes are. So I'll be speaking now about those ESRS 2.0, as Amanda put it. So the new ESRS that EFRAG has presented to the Commission. The Commission is expected to adopt them into a delegated regulation. So first of all, as Amanda mentioned, I mean, there's a massive reduction of the data points, which means that reporting is far less constrained. You know, it's far less of a tick boxing exercise, and it's much more principle based. There is an explicit emphasis on materiality analysis or assessment in terms of making it more flexible. I'll speak about it on the next slide. And there is also, you know, let's say, clearer rules for aggregation and disaggregation of information. There are some clarifications about the value chain, and there's a bunch of reliefs which make the sustainability reporting, let's say, easier should the company encounter, let's say, objective problems and obstacles such as undue cost or effort, which would be required to obtain information. Also, activities can be excluded from the calculation of metrics or KPIs if those activities are not a significant factor in those metrics or in the impacts, risks, and opportunities that the metrics are supposed to illustrate. When it comes to the value chain, if it is difficult to get the, let's say, reliable data from the entire value chain or that particular segment of the value chain where it is material, the standards now allow only partial disclosure of such metrics with, you know, with some disclaimers and so on and so forth. So these are basically really important changes that make the sustainability reporting more flexible and kind of, you know, reflective of the practical hurdles in that companies encounter. So that's one way how this is embedded in the new ESRS. But let's go to the next slide, because that's the more important one, because it speaks directly about the implementation of this risk-based approach in ESRS 2.0. So first of all, the ESRS 2.0 clarify that reporting, according to them, is to be done on the basis of the fair presentation principle, which requires faithful representation of material impacts, risks, and opportunities. And this has, you know, very important implications also for companies that will remain outside of the CSRD scope, but more on that later. And there is a greater emphasis on entity-specific information to be added on top of the data points that are standardized in the ESRSs. So all of this goes very much in the direction of the due diligence. Secondly, there is a strengthened filter of materiality of information, meaning that only the information which is relevant for the decision making by users of the sustainability information should make it to the sustainability report. So this hopefully will, let's say, make the sustainability reports more focused and less voluminous. This standard is based on so-called reasonable knowledge user standard, meaning that you consider users who are reasonably knowledgeable about the issue you're reporting about. And the third area where the risk-based approach in ESRS is really clarified is in the DMA. DMA stands for the double materiality analysis. And there are a couple of, let's say, clarifications in the new standards. The first is that the issues that are clearly material, for example, in a sector or just, you know, on a sector agnostic basis, that these issues can be simply declared to be material without much assessment, without much hassle. This is called top-down approach. The standards also clarify that a detailed assessment, where you really dig into the issues, you try to get the information from your value chain partners and so on, is needed only or specifically for the impacts, risks, and opportunities. That's what IROs stand for, where their materiality is not evident, and this can be the case where there are some specific impacts, that manifest in companies' operations and in the value chain. So it's not like child labor is material, but there is an issue with child labor in this particular region with this particular supplier. So this is where you can expect that there will be much greater, let's say, need for information exchange between business actors. And finally, as I've already mentioned, I mean, part of this concept is the concept of prioritization of areas for such assessment and of the specific context where there are some basically suspicions of let's say, heightened risk of adverse impacts. So those of you who are familiar with the due diligence would recognize, the echoes of the due diligence in this regard. And the companies that have to report, I mean, they will be guided by these principles, which are supposed to make the reporting easier, but also more targeted and more focused on material information. Let's go to the next slide where I just want to recap the fair presentation principle, because it's a kind of a new thing in the ESRSs. And basically it says that the information that gets into the sustainability reporting should meet the basic characteristics of information. That means it needs to be relevant for users. It needs to faithfully represent the impacts, risks, and opportunities, and that the material information can be obscured when it is hidden by immaterial information, such as too much information on the CSR activities. There are some expanding qualitative characteristics that I will not get into, but the third principle here is that the information that is provided according to the ESRS's data points need to be supplemented by the entity or company specific information that is needed for understanding of those impacts, risks, and opportunities. So this again will drive a certain, let's say, type of information request throughout the supply chains. Let's move to the big question, please. So what does this new setup of the CSRD, CSRD, and the ESRSs say about the exchange of information between businesses? Because this is very important for those companies who fall out of the CSRD. Well, there are, let's say, 3 areas where the legislation clarifies what are the legitimate requests or what is the information to be exchanged. 2 of them are on the CSRD or reporting side. And the first is information which is covered by voluntary standards. The voluntary standards are going to be adopted by the European Commission on the basis of the so-called VSME recommendation or VSME standard. It should be very similar, but it has not been yet adopted. But essentially, the information which is covered by these voluntary standards is a fair game. Any company can request any company in their supply chain and so on for the information which is included which is covered by those voluntary standards. So there's no regulation of that. Secondly, the CSRD introduces a special regime for the information which the big companies might want to request the smaller companies in their supply chain that exceeds the information which is covered by the voluntary standards. Now, the CSRD does not prohibit this, but it puts a certain brake on it. It basically says that such information request is possible if the requesting company informs its business partner that this information exceeds the voluntary standards and that it can theoretically reject, providing this information because, well, that's how the private law works anyway. So those are the 2 regimes. So there's not an absolute prohibition, but there is this kind of a little bit of a kind of a brake put on the information that exceeds voluntary standards. Then there is a regime under the CSRD, under the due diligence directive. And this one sort of trumps the CSRD regime. That means that if there is an information that the big companies or really large companies under the CSRD need from their business partners, they can request that information regardless of any kind of breaks or limitations in the CSRD. And this is the information on severe impacts and their management. There is a specific, let's say, break on such requests in the CSRD itself, saying that companies should do it only if such information cannot be obtained from the public sources, and so on and so forth. I will not get into the details, but in principle, it is a legitimate information request. What is not regulated by this new regime is sector-specific information. It's a little bit of a question mark how this would work, and information that companies want from their business partners for other purposes, such as procurement and so on and so forth. So this absolutely does not address, the all kinds of ESG information requests that you may encounter from your business partners if those are not for the reporting or due diligence purposes explicitly. So let's move to the next slide, please. So just a summary. What are the legitimate business-to-business requests for sustainability information as per the new CSRD, CSRD, and the ESRS 2.0? So the so-called VSME metrics, that's the content, the expected content of the voluntary standards, the basic ESG metrics. All large companies can request such information from anyone, and the legislation does not go into their way. Secondly, information on the exposure to climate risks and companies' climate targets and potentially transition plans. Well, the financial institutions and investors, banks, investors, and insurance companies can request this information because they need it for their own purposes because of the specific legislation that they are subject to. In the second part of my presentation, I'll go a little bit more, into more detail what this really means in practice. Thirdly, companies that are covered by the CSRD can legitimately request information on the exposures to and management of severe impacts from their business partners under certain conditions. But this is also something that you can expect. And finally, there may be some other requests which are not for the reporting purposes but for other purposes. And basically, if it is common in a specific sector, to exchange such information, it's going to continue. So, for example, in many industries, companies need to provide to their customers information on their products' carbon or GHG footprint. So that is something that will remain, and that is a little bit outside of this new regulation of the B2B requests. Okay, I'll stop there, Amanda. I'll hand back to you, and then just in the second part of my presentation, in like 15 minutes, we'll go into the details of what this really means in terms of like decision on what to report or how to approach the ESG in your company. Back to you.
Thank you very much, Philip, for this pragmatic overview and for guiding us through what the main changes actually mean for companies when we look at really what is going to happen in practice. And yeah, again, highlighting the role that probably everyone in the audience has to play in the reporting ecosystem. So I would just like to take a moment now to reflect upon what Philip has mentioned, and to extract the main, let's say, the main elements that are present in those changes that we believe will drive the reporting exercise. So what does this mean to you in practice? Importantly, we see a new direction of travel in the reporting, in sustainability reporting. So as Philip already mentioned, the standards have been considerably reduced. So they have been reduced an overall of 71%. We are here talking about the data points. So data points in the ESRS have been reduced by 71%, 61% when we only look at mandatory data points. And I think an important message to provide here is that yes, the draft ESRS have been considerably amended and simplified and streamlined, but the main elements, such as the double materiality assessment and value chain reporting as well, remain, and so the, let's say, core principles of risk-based prioritization and fair presentation, which in the end builds on the previous concept of characteristics of information. And those principles not only make the reporting exercise more aligned with the long used and widely used reporting international standards, but they also, and again, as Philip explained, bring the reporting exercise and the due diligence exercise closer, and so they generate more synergies for efficiencies. What does this mean in practice or in detail? So the double materiality assessment has been considerably streamlined. I won't dive a lot into this because it was already mentioned, but in essence, what the changes tells us is focus on what is material to you. And the addition of the top-down approach is quite interesting. So now the double materiality assessment is more flexible. And for instance, companies that might have thousands of products in the value chain and they don't know where to start, instead of mapping every single business partner, doing a proper or an in-depth assessment of all their activities, and then based on those direct results, prioritizing or extracting their main impacts, risks, and opportunities, and prioritizing the business partners, they could instead look into their own structure, main products, activities, operations, geographies, and then using a mix of common sense and also widely available sector data, they could already identify where to focus on and what information to report. So this approach requires less resources, it's less resource intensive. And it gives more flexibility for companies. And also interestingly, the double materiality approach, before there was an obligation for companies to update it every year. Now what the ESRS tell us is you don't have to update it necessarily every year, but you have to update it every time there are significant changes that require you to update it. And so the message here is not you no longer have to update it. It is also linked to the continuous improvement logic of the due diligence exercise, where it says the double materiality assessment is actually a living exercise, and it requires companies to be proactive and to be on top of any changes that may happen, that might require the double materiality assessment to be adjusted according to the new circumstances where the company operates. There's also been more flexibility added for the reporting on the value chain. But the main, let's say, value chain reporting as one of the main elements of both the double materiality assessment and the posterior reporting of policies, actions, and targets remains. Philip already mentioned the couple of reliefs that have been introduced. Interestingly, there's no more explicit preference for direct data over estimates. And here I would like to specify this because there's no explicit preference for direct data in the text, but the text still asks companies to disclose their reliance on indirect sources, so secondary data. And also in the climate standards, the application requirements also still ask companies to prioritize the characteristics of the data that we collect. So for instance, to prioritize data that is more focused on the actual activities and technologies used in the sites of their business partners. So you don't have to necessarily collect this information, report this information for all your business partners, but this is a, let's say, kind of a nudge for companies to progressively move towards more quality data. And also it gives them room for finding the best balance between primary and secondary data. And then finally, the structure has also been, the structure of the overall ESRS has been considerably amended. And all in all, this means that it's been, the data points have been considerably shortened, as we already explained. They have been centralized. So there will be the main general disclosure requirements, which will show the main, let's say, the central data points that then need to be applied per topic. There are still, of course, the topical standards, but the number of data points there have been reduced. And so how the exercise would look like is basically based on the double materiality assessment. So at the end of the day, the companies will have more room to assess where they should focus on and what is important to report. And this takes me to the next slide, which is what this actually means to you as a company. So there are less, let's say, boxes to tick. Companies are no longer required to follow a long list of disclosure requirements, but instead to focus really, and sorry for repeating it again, but it's really at the core of the new direction that we observe, to really focus on what is material to them, both in the information that needs to be reported as policies, actions, targets, metrics, but also in the double materiality exercise itself. And this will, of course, have an implication for them to focus on their individual cases. This also means that there will be more room for companies to allocate resources into setting up a system that actually works for them. And it also means more accountability. It means more accountability because there will be less of a focus on the compliance with each of the disclosure requirements, let's say, ticking boxes, and more on how the companies actually build up the materiality assessment, how robust it is, and how they manage their impacts, risks, and opportunities, which is in turn in line with the due diligence exercise itself, as it was previously mentioned. And this was also mentioned, but I thought it was important to restate it, that the whole exercise is based on the risk-based prioritization and also fair presentation principles. And at the end of the day, to put it very simple, what those principles are asking companies is to report information that is relevant, that is reliable, that is understandable, and that can be used. So information that makes sense for you to report and for the users of information to access and to utilize. And I will stop here because I would like to allow for some questions from the audience. We have already received 2 questions. The first one is as the ESRS have not been adopted yet, this means the EU branch must report in 2029 on financial year 2028. Prior to a change in our business, we were originally a second wave business with report obligation. Philippe, I don't know if the question is clear to you or you would like to answer this orally.
Yeah, there was an exchange on it there. The question is partially answered already. But Amanda, are we doing the Q&A now or after the full thing? Happy to answer the questions right now, but you need to then stop me so we don't run over.
I think it makes sense to have a Q&A now.
Okay.
Yeah.
Right. So the question is about the basically reporting by the non-EU groups, right? And there is a double obligation, let's say. So if there is an EU subsidiary of a non-EU parent company, then this EU subsidiary is treated as any EU company. That means if it's on its own, including let's say its own subsidiaries, meet the thresholds of the CSRD, then it should report as any European company. That means, from the financial year 2027, unless it has been already reporting as part of the wave one. Now, the second obligation, which is, let's say, independent of that, is the obligation which is placed on, let's say, which is related to the group reporting, but at the level of the entire non-EU group. In this regard, this EU subsidiary is a conduit in a sense that the obligation is related to the entire group, but it is the EU subsidiary which is obliged to make such a consolidated global report available. There are different thresholds applicable to this non-EU group reporting. So it may happen that some of the EU subsidiaries, which would not on their own trigger their own CSRD obligation, would still nevertheless be caught in this indirectly in this non-EU group reporting obligation. And for them, the reporting year, if I'm not mistaken, is the financial year 2028. I mean, for the entire non-EU group. But I think that was captured in your timeline. So please, Amanda, correct me if I got the year incorrectly.
Thank you, Philippe. We have a second question now. I think it's an interesting one. So, despite my sustainability-based opinion that the CSRDs should be implemented as soon as possible, our management is delaying implementation because it does not yet see the need. If my client as a wave one company already has to report under the CSRD, and am I then also obliged to provide them with VSME, sorry, this is how I call it internally. Yes, VSME information before 2028. And should I consequently obtain this information immediately? I think this ties to the point that you made before, right? About the value chain cap and what information is regulated, what information is not regulated. So if you could provide some.
Yeah, I understand. Look, it depends, right? It depends on the specific facts and circumstances of that of the situation they're in, and what you can essentially expect. Now, the new ESRSs will not enter into force until the financial year 2027. Now, the Commission is exploring options how to kind of speed up their applications and so on and so forth, and they can already be used for, let's say, interpretation of the current ESRSs. But the bottom line is that until financial year 2027, the companies that are already the Wave 1 companies are reporting according to the old ESRSs. And the old ESRSs include this kind of a phase-in or a transitional period for value chain information, which means that technically your client does not need information from you for their own reporting, at least until financial year 2027. That's what the law says. But they absolutely can request that information if they decide to do so. So I think this is more about speaking to the client and of your company and figuring out what is it that they would require and so on. And they might not yet know, right? So it's difficult for me to provide a definite answer. But looking at your question or at your dilemma more broadly, then I would just say, as I've tried to illustrate in my slide, the information which is covered by the VSME, that's going to be a fair game. Like that's going to be an information that anyone can absolutely request from your company without any justification, regardless of their materiality, and so on and so forth. So that's just something to look into it. Some of this information is trivial, like workforce composition and so on and so forth. Some of this information is a little bit more difficult, especially on the climate risk, right? So it depends if some of your business partners are, for example, financial institutions, they would probably like to see some information on your exposure to climate risk or maybe your climate transition plans and so on. And it takes some time to do this. And my recommendation would be that for any reasonably sized, reasonably large company, it is a really good idea to do a climate risk analysis. Not a nominal one that some big consultants are often doing, which is not going to provide you with some useful information, but something more flexible, more more I would say fit to your reality, and it can give you quite interesting insights for your own management. In addition to the fact that then you would have something to present to your business partners. There is also GHG Scope 3 emissions covered by the VSME standard, even though in a slightly, I would say, weird way, because it was not meant to be a standard. And calculating Scope 3 emissions also takes a couple of years to, let's say, settle. So my recommendation would be, well, absolutely, the VSME will be just the standard for the entire market. And it does make sense to gradually implement it, gradually improve your ESG data collection system and so on, because there's the cheaper way. There's more cost-effective way to do it, gradually in steps, rather than to be faced with some kind of a last-minute request and scrambling for responses, when it comes to hit you in like a year or two because of your clients. So that's the best answer I can provide to you. Probably have thought the same, but yeah, that's the world we're living in. The market still
Thank you,
needs
Philip.
to awake to the new reality, and it will probably take some time to your clients as well, to your management, to fully absorb the new the changes.
Thank you for the practical answer. And I think Valentina would also maybe like to add something here.
No, Amanda, actually, I was just helping out with sorting the questions. Sorry for
Okay, brilliant. No worries.
confusing to you. Apologies.
I might, because we still have a few minutes for questions, I might want to link the previous, well, the last answer with the next question or comment, which is about suppliers that are not in the EU. We ourselves from amfori, actually, we've in my exchanges with members of our climate group, I've heard, and also in the past in deforestation, comments from members having difficulties to access data from suppliers, mostly based in China, saying that it was the first time that they got those requests, and then if our members are not, well, it can be difficult for them sometimes to know if that is true or not. So I wonder if you, Philip, have any views on what the value chain cap, so VSME, if that might have an impact, or what impact it would have for non-EU suppliers. Do you think that this will be uptaken by the market and set some harmonization, or how do you see this?
Okay. Well, the value chain cap applies equally to information requests to EU suppliers as well as non-EU suppliers. It's not discriminatory in this regard, but I don't think that really solves the issue here. Now, what's important is that both CSRD as well as CSRD, and when I speak about CSRD, I mean also the ESRSs, very much, let's say, strengthen or emphasize the prioritization and risk-based approach, right? So they would basically tell you, well, yeah, indeed, if the EU suppliers are not your problem, or if there are no heightened risk of adverse impacts, but they should not be, right, in the EU, then you don't need to actually worry about those. You don't need to send them information requests, not even the VSME and so on and so forth. You can just sort of ignore them and you can focus or prioritize those parts of the supply chains which are indeed more risky, such as the Chinese and Indian suppliers. So they absolutely send you in that direction. But they also say that you don't need to always get the information directly from them. You can rely on secondary information in order to determine whether there is something material. If there is something material, then you don't always have to seek quantitative information. There are different ways how you can report on such an issue. It depends very much on the specific case. But basically, the ESRSs go a little bit in your direction by saying that you are not supposed to do unreasonable, right? But you're supposed to improve your understanding and insights into those matters in China and India, and gradually improve the data collection from those, let's say, hotspots in the value chain without undue cost or effort. If you encounter undue cost or effort, if you encounter the issues with the lack of data quality in terms of like reliability, you ask them how many slaves you have. Well, okay, good luck with that. Now, I'm of course exaggerating, but yeah, such situations happen. Then if you encounter such situations, including lack of data quality, then the standards just tell you, well, be transparent about that, and you don't have to report those values. But you also need to report on like what you're doing about mitigating those risks and impacts, and also what you're doing in terms of improving your understanding of the situation and your basically ability to get the necessary data. But even just one more thing, but it's not like that the end goal always need to be direct data from the business partners, or even quantified data. That very much depends on what kind of information is needed for understanding of those impacts and the effectiveness of your management of those impacts.
Thank you, Philippe. And I mean, we have 2 minutes left, I think, for a quick one. I think this is a good one. And I think it refers to the double materiality assessment as the filtering of information. So our participant is asking what ESRS reporting values are values of a very risky company. So if I understand correctly, if the ESRS indicate what thresholds, if there's any, if the ESRS indicates any thresholds in terms of values for defining what is material or risky or not. To my understanding, this is not really the case. So even in the previous version, companies had to set their own thresholds, and then similar to what Philippe mentioned in the last answer, there's a continuous improvement logic in the reporting exercise and in the ESRS, where the company has to use common sense and then explain how they have built the double materiality assessment and the thresholds that they've been used. I think that this logic has only been reinforced with the top-down approach inclusion. So there's more flexibility for the company to come to the conclusion, basically, that something is material or not by using widely available information. But I think at the end of the day, it falls down to the company to set their own thresholds for materiality and for reporting the information. I do not think that the ESRS prescribe any specific values above or below which something is material, but correct me if I'm wrong, Philippe.
No, you're right. Now, I'm not quite sure that that's what the question is about, possibly, but I think it's an important one. But Harry, if I may, if you can specify your question, that may help us to provide a more precise answer. But what you're saying, Amanda, is very important, and that is the ESRSs indeed do not prescribe thresholds. Now, there are some metrics for concerning own workforce where those thresholds are sort of suggested, right? So like on adequate wages and so on. But as a general principle, the thresholds are indeed in the hands of the company. Now, but what's important to add that with the addition of the fair presentation principle to the ESRSs, the company does not have to always report the thresholds or just provide every single information about where did they draw the line, either for the impacts or for the specific metrics or information and so on. But if there is a sort of a borderline issue, or if there is an issue which is kind of a common in a sector or commonly reported in the sector, but the company decides not to report it because it's below its maturity threshold, then the fair presentation principles sort of saying, oh well, this is where probably you need to provide a little bit more explanation and tell the users or the readers, like, why did you decide in that way? How did you set the thresholds? And the thresholds do not have to be quantitative; they can be qualitative as well. Yeah, it's a larger discussion. But you're absolutely right. I just with this kind of a caveat. Oh, perfect. And you got the question right. It was me who was confused. So thank you, Harry, for clarifying.
I didn't interview because I think this was also an important comment. All right, I think we're good in time, and we can move on to the next to the second part of the and last part of the session. Actually, first I would like to let's see if I manage to set up a poll, because I would like to understand a little bit also what our members think. So I would like to do a quick poll to see where our members stand. Okay. I think it should have popped up now on everyone's screen. So based on what we discussed, to what extent do you agree with the direction of the draft 2.0 standards? Agree, more or less agree, or do not agree? Okay, let's give a couple of more minutes for people to reflect, because the numbers keep changing. Okay, a few more seconds. Voila, I think everyone has answered. Thank you very much. So we can end up the poll and share results. Voila. Interestingly to know that there's a large majority that more or less agree. Maybe I should have included more categories into the answers, but I will be very interested to hear more about those who more or less agree after the webinar. We are here to support you, and also with the I forgot to mention in the introduction, with the upcoming public consultation on the drafted ESRS, which we expect around, let's say, March, April. So we will be looking forward to engaging more. And also you can, of course, reach out directly to Frank Bowen, to Philippe, or anyone else. We included the emails in the slides. Okay. So I think we can move on to the second part of the webinar. The first one was more about what the changes mean to you and what has changed. And now Philippe will guide us through more practical examples of and recommendations on how to implement those. Philippe, the floor is yours.
Thank you, Amanda. So let's move with the slides. All right. So I'll be speaking first about the situation of the companies that are, let's say, outside of the scope, before speaking about the application of the ESRSs, which may be relevant for those who remain in the scope of the CSRD and those who decide to apply ESRSs voluntarily rather than the voluntary standards. But first, for the companies that are outside of the CSRD scope, the dilemma that you'll be facing is which standard to follow for reporting. Of course, you can decide to ignore, or your management can decide to ignore any kind of a sustainability reporting, either published one or just for business partners. But those of you who would not reach that conclusions, you would have this choice. Is it a VSME, or that will be translated into voluntary standards delegated act, or it is the main set of the ESRSs after the simplification. And it's important to distinguish, between these two standards. The VSME, or the future voluntary standards, basically include simplified metrics that were designed for the small and medium-sized businesses, below 250 employees. That's how they were built. That also means that they do not answer the methodologies which are explained in the VSME, do not really answer some of the more complex questions that you may encounter when calculating these metrics, for example, in a more complex, business environment, including several subsidiaries and so on and so forth. So the methodologies for calculating the metrics and so on, but also providing some narrative information, are simply a little bit rudimentary. It might not serve the needs of, let's say, more complex enterprises. Then what is missing in the VSME is any kind of a framework for reporting on impacts and risks. The VSME just gives you a bunch of data points and disclosure requirements that you need to fill in. Then you will have essentially a spreadsheet with the information. And there is no materiality assessment, no materiality filter, but that also means that there is no kind of a way how to report on what your material impacts and risks are, or simply not a disclosure requirement for that, with an exception of the climate risks, but more on that later. Now, you may also choose to apply the ESRS, the full one, which may be a better choice if you have, let's say, more complex corporate structure, or if you are simply larger, or if you have the exposure to the impacts in the value chain, and so on and so forth. The reporting, according to the ESRS, allow focus on the impacts, risks, and their management in the report. So it's not a spreadsheet with numbers and some narrative information. It allows you to actually build some kind of a coherent story and explain, what's your risk exposure or exposure to the impacts, what you do about it, what's material, what is not material, and so on and so forth. This may be relevant even for companies who just wish to demonstrate that their exposure to the risk factors is actually low, because that plays a role a little bit when you're part of the value chains that involve really big companies who are subject to the CSRD. They need to prioritize their due diligence, and if you can show them that you have the situation under control, that means they are not supposed to prioritize you, and they will leave you alone, if I may put it that way, and focus on areas where they really should focus. And there obviously is a materiality filter which allows you to basically put the right focus and the right level of detail where you need to do that. So it really depends on your risk profile and the size. Now, the reason why we're sort of recommending for the larger companies to use the ESRSs, even if they're outside of the scope, is that, first of all, the ESRSs are much more simple to apply compared to the previous iteration. And secondly, you'll be still doing it voluntarily, which means that you will not be subject to the audit, which has been a source of a major pain for the companies in the first wave. So that takes away a lot of problems, if I may put it that way. Let's move to the next slide, please. So we've prepared for you a little bit of a kind of a decision tree, how to think about sustainability reporting and elements of it. So first of all, the very starting point on the top of that arrow is the basic materiality screening. Sort of a top-down materiality analysis, nothing too complex, but basically determining what are the key issues in your sector that you might be expected to report on, maybe on top of the basic voluntary standards or VSME metrics. And you know those issues, right? I mean, that shouldn't be, in any way difficult for you. You already know what those issues are, but you need to do it always, because this is information which can be expected from you alongside the information that is covered by the VSME. Now, the second step is to decide whether it's actually a good idea to apply the voluntary standard. I have here VSME, it will be a voluntary standards delegated act. And again, I mean, for vast majority of companies, nearly all companies in the market, this is a really good idea, because that information which is covered by the voluntary standards is a fair game in B2B relations. And it's it's a good idea to add to that set of information also the information on inherently material topics that you know from your basic materiality screening. Okay, so this is sort of an always category. But then we move to the climate risk. Now, the climate risk is covered by both VSME and by ESRSs at a different level of, let's say, detail, but it's in both standards, at least so far. Now, so whether or not to do it, well, very much depends on the risk exposure, but more importantly, the level of detail in which you need to carry out a climate risk assessment depends on that risk exposure. So our recommendation would be to do it in some form always, but it's a very flexible concept, and both ESRS and VSME are not really prescribing the level of detail you are supposed to apply in that assessment. I just want to recommend you to avoid overly formalistic approach to the climate risk. Having a good climate risk assessment is quite important for the businesses who rely on external sources of funding from either investors or from investors in terms of the public markets or on credit from banks and so on, because these institutions will need information on your climate risk exposure. If you need to do it in kind of, let's say, in greater detail, it's really useful to look into the ESRSs rather than just follow the VSME, because in the ESRSs you will get more guidance on basically how to do it. There are more pointers basically that helps you to make some of the decisions, both on the detail of the disclosures, but also on the methodology. Now, moving on. Should you jump into the full ESRS application beyond just following VSME plus maybe consulting ESRS for the climate disclosures and climate risk disclosures? Well, generally, it's a good idea. So I've tried to explain on the previous slide for companies that are large in the accounting sense. It's also a good idea if you have a higher exposure to risk or impacts, or if you are operating in certain sectors that basically are connected to the high risk value chains and so on and so forth. It's mostly for those materiality reasons that I've tried to explain already. That doesn't mean that you need to do a detailed materiality assessment. According to the ESRS, this is needed only in case that there are actually specific impacts which require such a deep materiality assessment in order to basically either document the impacts or decide on their materiality. Now, and the last bit is on the audit or verification. So as I've mentioned already, if you're not subject to the CSRD, then you can apply ESRS and you don't have to undergo an audit. So it's not mandatory for you. But it depends on the expectations of your business partners. And I suppose that what kind of makes sense is to not think about it in a binary terms. Do I need to audit it all or not? But rather, are there any specific data which it is useful to have audited or verified to build trust with my business partners? But it very much depends on your relationships with the users of the information in that kind of a B2B setting. So this is a short guide how to think about the whole ecosystem of sustainability information. Now I got 2 slides on the summary of the simplification options of those who already have an experience with applying the ESRSs. That means wave 1 companies or companies that have already, let's say, prepared for the application of the ESRSs, even though they were part of wave 2. Now, I'm not going to go into every single detail here because that's beyond, let's say, the time budget we have for this, and I suppose you will receive the slides anyway. But essentially, I have this organized by, let's say, reporting process and reporting area. So first of all, on DMA, on double materiality assessment, oh yeah, let me say one more thing before we jump into that. These are the implications of the changes of those general principles and general requirements in the ESRSs. So this comes straight from the language of the ESRS and the change rules, but you will not find anywhere this kind of a neat summary, because there are some changes in ESRS 1 with the general requirements, but then it's explained in other standards how it applies there and so on. So you will not really get such a summary simply by reading the ESRSs or just from some EFRAG publications and so on. So anyways, on the double materiality assessment, one big change is the distinction between different types of impacts. Those that are inherent to mostly your sector or geography. And for this, you can do just a very simple top-down assessment. And on the other hand, specific impacts, risks, and opportunities that are kind of, specific in terms of their manifestations in your reality, which deserve, let's say, more attention. Secondly, you also need to describe your DMA, double materiality assessment. It has been also a source of pain, where the ESRS now make it very, very clear in the application requirements that you are not supposed to describe common ESRS process or we've applied the criteria of severity and likelihood, yada, yada, yada. I mean, just meeting the basic requirements is considered boilerplate information, and you can focus only on a kind of a specifics of your process, where you put more attention. How did you deal with those kind of borderline issues? Did you engage stakeholders and so on and so forth? So mostly about that kind of a bottom-up approach and stakeholder engagement. So very much kind of a due diligence type of thinking. When it comes to the descriptions of the impacts, risks, and opportunities, now there can be a very brief description in the cross-cutting part of the report, and you're explicitly allowed to provide necessary details in the topical sections where you describe how you manage those impacts, risks, and opportunities by policies and actions. So that allows a more coherent narrative and better flow of information, avoid duplication, and so on and so forth. PAT, the fourth column, that stands for policies, actions, and targets. So wave one companies sometimes encountered requests from the investors to kind of slavishly repeat the same policies and actions for every chapter, for every impact, risk, and opportunity, and that's absolutely not needed. And the new ESRS has clarified that. So if there are, let's say, cross-cutting policies and actions that apply to multiple of the several impacts, risks, and opportunities, they can be described just once and referenced, in other cases. And the structure of the policies, actions, and targets can reflect your approach and, let's say, their relative importance from the strategy and business model point of view, rather than the ESRS structure. So there's really a lot of flexibility there. And when it comes to, let's say, selecting which information is material and which is not, and I'm repeating myself a little bit, it really depends on what users are interested in, considered as user groups, not kind of individual companies, individual rating agencies, and so on. And there is a kind of a strong warning against generic and boilerplate information or details on common practices and compliance and so on and so forth. That's not what's expected. So let's move to the next one, please. Now, more on policies, actions, and targets, right? So when disclosing policies, I put here the focus on the fair presentation of the managerial approach and organization. Basically, just describe how you do it, right? This is connected to those reductions of the data points, right? So that's mostly for the narrative information. So the ESRSs are really welcoming, kind of that you provide kind of honest information how things work in your company, rather than tying you into kind of a formalized tick the box reporting. There's even a sentence, the last one, that information on legislative compliance can be really provided by a single sentence. You don't really need to go into too much detail there. When it comes to the activities, it's important to distinguish between kind of ongoing processes that do not fit the description of policies, and, let's say, key activities that have been undertaken in the reporting year. Now, for those processes, you can describe them by a short narrative. For the key activities, I would recommend to use a tabular format with the data points that allows you to present it in a tabular format. This is how best practice looks like based on our research into the first wave of reports. Now, what is a key activity, you may ask? Well, it can be quite easily identified by asking yourself, well, does it have a clear and significant effect on those material impacts, risks, and opportunities that I've identified, or on metrics that illustrate those arrows or targets? Now, if there is a clear and significant effect, report it. If there is not, then maybe you don't have to. On targets and tracking effectiveness. Now, again, the same question. I mean, is this a reportable material? I mean, is it important enough? Is it significant enough? Well, I would recommend to think about it in three, let's say, ways. Like, you know, if you kind of trigger one of these points, then yeah, it's probably material to report. Now, if you have targets set at the level of the metrics in the ESRS, especially those in the environmental part, S1 on workforce and the G1 business conduct. Now, if you have a target that is defined using those metrics, then it's material. Now, if you have set targets that are really, you know, tailored to your specific material impacts, risks, and opportunities, well, it's probably material as well. And the last bit here is that if those targets and metrics are really connected to your key actions that you have already filtered in the previous steps, that also kind of makes them material. Anything that's, let's say, more nuanced and detailed, it's probably outside of the let's say, this kind of a semi-objective materiality test that I've tried to put in here. Let's move to the next one, please. Now, there is often a question on like how to balance the narrative and quantitative information or metrics. This has been a major problem for the wave one companies. There, we would recommend, in line with the kind of a new approach in the ESRS, to think about your impacts, risks, and opportunities again in three categories. Let's say there are these categories of, let's say, top-down impacts, risks, and opportunities, or inherent issues in your sectors and so on. But for these, the information provided by the standardized metrics in the ESRSs really represent the most significant information. And you probably want to disclose on your policies and actions for these inherent issues and so on. But really, that's the area where the detail is not so much necessary. And I would encourage you to think about these kind of narrative information mostly as a note to the metrics, right? So that usually helps, and that helps you to avoid, let's say, those boilerplate disclosures. Now, you may have identified some specific impacts, risks, or opportunities that are dependent on the context, right? So these may be manifestations of those inherent impacts in your reality, in your value chain, and so on. So there, when you think about the metrics, should you have metrics for that, it's important to consider whether you need to disaggregate them a little bit, right? So if you are reporting on the impacts related to the water stress, it doesn't really help that you provide kind of a global figure. It's all about those regions where, you know, this manifests kind of in terms of a heightened risk and so on. Now, when you provide policies and actions, so in information, in addition to, let's say, general information, what these policies and actions are, these account for kind of a specific approaches that you have embedded in those policies and actions for those identified contextual factors, whether it's a geography or it's something else. So let's say a greater level of detail and specifications of those policies and actions is desirable for these, let's say, specific impacts. Now, there may be a third category of impacts, risks, and opportunities, which actually may overlap with one of the first two categories. And those are the IROs, or impacts, risks, and opportunities, which actually require changes to your business model, strategy, or like key activities. So on this, our recommendation would be to connect the metrics with the targets and activities. This is really where it is needed. And when it comes to the narrative information on policies and actions, this is where the greatest level of detail is necessary compared to the other types of the material impacts, risks, and opportunities. And the most significant information is indeed on the interaction of these policies and actions with their strategy and plans. So not so much, again, on the compliance policies, but really what is being done to change the business model and strategy, or to evolve it into something more let's say, or better addressing those impacts, risks, and opportunities. Okay, so let's move on. Now we've got a couple of recommendations for the S, last two slides, and then we'll wrap up. So there are, let's say, some specific additional disclosures in the S standards, and you will see that the new ESRSs are much more, let's say, slim when it comes to the S standards compared to the first set of the ESRSs. And we want to draw your attention to a couple of things. First of all, there is a new disclosure requirement which merges information on engagement and remedy processes. And this, and it is much more prominent now, much more kind of outstanding than in the previous iteration of the ESRSs, which means that such information is really key and it should be prominent. It's an information on basically how your process or system works in this regard. It's not an information on your key activities that can be provided as well, but under the activities. But the engagement and remedy process, which you would recognize from the due diligence, is really kind of elevated in terms of importance of disclosures under the new standards. Now, remedy processes and grievance mechanisms can be often part of the whistleblowing processes in the company. So the standards are telling you explicitly, well, it's possible to describe it either in the S or in the G part and just cross-reference the other part. I mean, if you have a one process, describe a one process and that's it. But don't forget to disclose or describe to what extent this can works as a grievance mechanism. And it is also necessary to describe how you evaluate effectiveness of those channels, let's say from the perspective of the affected people. And finally, engagement of affected people in the evaluation of effectiveness of activities and setting of the targets, so that is not the remedy mechanisms, is also a relevant information. So you can see this thread on the in terms of the engagement of affected people that now goes, that's much stronger and goes through the S standards. Let's move to the next one. Now, and here's a short cheat sheet on on how to recognize material and immaterial information when it comes to the S area. And we've included it here in this presentation because this is where companies from the first wave often provided way too much information. They focus on issues that were really not material, mostly because, you know, their policies regarding own workforce and so on are kind of robust. And so there was this kind of inner pressure in the companies to provide, you know, good account on all the fantastic things they are doing, but this was often at the expense of materiality. So what's material? Explanation of impacts in terms of, like, you know, high-risk factors, vulnerable groups and such like, and distinguishing the impacts in line with the due diligence, let's say, terminology. Which of the impacts are kind of we're causing, which of them we're contributing to, which of them are merely directly linked to us by business relationships. This is quite important to basically distinguish this to enable the understanding of the impacts and the adequacy of your measures to address those impacts. It's important to prioritize the impacts that are seen as key by the affected groups. That's another, let's say, material information. It's also an explicitly, let's say, required information, the description of the long-term strategies and activities for the risks and opportunities, that is the financial materiality side, that affect business strategy and decision-making. And on the impact side, of the severe impacts which require change of some key practices and so on and so forth. So I'm repeating a little bit what I've already said about like what's on the slide with the activities. You want to stop me, Amanda? How much time?
We have less than 1 minute left. So maybe if we can kindly start wrapping up, that would be great.
Yeah, there's the last slide, right? So I'll just finish. Okay, and immaterial information, I'm just repeating myself, excessive details of commitments and general statements, standard policies and processes in your sector, or details on the management of the IROs that are really not strategically important or are not relevant really to the users of the information. But the rule of thumb is that if you're reporting on your corporate citizenship or some kind of a CSR information, it's probably not material. Thank you. That's it.
That was quick and useful. So thank you very much. Okay, we have reached the the end of the webinar. I hope that the insights shared here were useful. I would like to thank Philip for bringing your expertise and also your key insights from being part of the EFRAG technical body as well on board to this webinar. Maybe I would like to wrap up with a couple of key messages very quickly. So focus on what matters to you. Look into the core principles to drive your exercise, and also to echo what Philippe emphasized in the past. Think about the role that you have to play in the ESRS and wider reporting ecosystem, regardless whether you are in or out of scope, and how you can use the tools that are available, the ESRS or the VCME, to help you continuously improve in that journey. So just to recap, the slides will be shared as well as the recording. You have the recording of last week's webinar in the slides as well, if you want to refer to the discussion about the Omnibus. And finally, you also have our emails at the end of the slides, so feel free to reach out if you have any further questions or comments, or you want to engage with us for the upcoming consultation. And with that, I would like to wish you a very good day and a successful reporting preparation exercise. Thank you very much.